Joining us right now to talk about the outlook for Tesla and tech stocks is Gene Munster, managing partner at Loop. And Gene, we saw this stock under some significant pressure. We've seen it come back a little bit. How are you feeling about things as we kick off the new year?
Becky, I am a long-term believer in Tesla. I think that the shares are undervalued. Near term, I would be cautious. I think that there's going to be some earnings pressure on this based on some of the discounting that has happened. And there is this bias when a stock is down as much as Tesla just to want to own it. I sense that too. We want to own it in our funds. We don't own it yet because we want to optimize that opportunity. And so the key here, of course, is we know the delivery numbers. We know the growth numbers. Up 31%. That was about a 2x what the overall industry growth rate was. Typically, Tesla grows at about 3 to 4x the industry. So some of that gap, that revenue growth gap has closed. The delivery gap has closed. But again, I want to anchor back into what I think is going to be the A topic when they report on January 25th, which is going to be earnings. And just a quick math here, of course, they are discounting in China. They lowered prices by 13%. If you assume there is no other discounting across the globe when it comes to Tesla pricing, that would have a negative 15% impact on the March earnings. The street's looking for about $1.40 right now. If you start to factor in that there may be some further discounting, that number goes down. So I think that investors should generally expect about a 25% haircut to the March earnings. And that does not sound very optimistic from someone who's been bullish on Tesla for a long time. But I do want to underscore, I remain positive on this company. I think ultimately there are a few good reasons to own this in 2023. But I think that we can see some more pressure in the near term.
Gene, when did you sell Tesla shares? Or you had them in your fund at one point?
We did. They basically tapped out on a market cap. It kind of blew through a market cap provision. So it was a long time ago, but we had owned it a lot lower. But as it went up, we had to sell based on some market cap. I think we had a maximum market cap in that fund of like $400 billion. So when it blew through that, we had a forced sell on it.
At $400 billion?
Yes, I think it was.
What did it go to? You didn't get. You didn't.
Yeah,
you
we missed a lot of the juice. We did,
What?
Joe. Yeah, we missed a lot of it. I think one of the challenges that with some of these funds is that these small and mid cap funds, they hold these companies until they're very big, and I think they lose some of their direction. And so we
you're
want to be
supposed to let your profits run and cut your losses, not cut your profits and let your losses run, right?
Well, in this case, we had some rules around the size of companies for being a small and mid cap company. And when it blows through some of those targets, just to maintain that.
Hey, Gene, keep going. Sorry.
No, I was just going to say, yeah, we just want to keep our products in line with our market cap provisions. So